My name is Professor Adam, and I'm going to teach you how to become a professional cryptocurrency investor. I've been active in finance for almost 9 years, and I've made millions of dollars without the need for one. I'm going to teach you everything that I have learned throughout my years of finance, all of the study, the research, the pain and suffering, so you too can learn from my experience and become elite. So what is cryptocurrency investing? It's buying digital assets and then getting paid massive amounts of money at a later date when you sell them because they have multiplied in value. You'll be taught multiple methods for how to do this, leveraging my years of deep research and world-class systems. When people invest by themselves with no mentorship, they usually get scammed quickly or lose all of their money because the market moves are too fast or confusing. But with my systematic investing, you develop high-quality criteria that tells you clearly what to do to make profit over the long run with far less risk. Most fake trading salesmen online seduce you with flashy Instagrams, and they teach the same ineffective shit between different accounts. This university and this campus specifically is different because I am an effective professional and I will guide you every step of the way. After going through the basics, my masterclass will teach you up to 5 uniquely profitable methods invented by me that will make you elite. So how much do you need to get started? Well, it's up to you. The more you have to start with, the more it's going to become once you multiply. If you look at the amount that you want to invest and you say to yourself, this is a huge amount of money, this is a good amount, and if I was to multiply it, it would meaningfully change my life, then cryptocurrency investing is for you. So if you're ready for the 100, 1,000, 10,000% gains, then get ready to go through the hundreds of lessons that we have in the campus to make you elite, and I'll be here to guide you every step of the way. GM everybody, welcome to another episode of Investing Analysis. Good to have you with me. Good morning, good evening, or wherever in the world you're from. Without further ado, let's get into the analysis. Now, before we get started though, I just want to remind you always to be watching these videos, always to be checking in. It doesn't matter whether you're a long-term investor, navigating your ship and going up to the bridge every single day to check your heading is critical. There is no fucking once a week investor every day. It doesn't... I know that sounds insane because all of you are incredibly lazy and the only thing that enters your mind is, if only I could make millions of dollars without any work whatsoever. Oh, I'm sure Adam will help me achieve that dream. No, you must always be figuring out what's going on and adapting and orientating yourself with the data. There is no casual tourist fucking application of investing. You either take it seriously or you don't fucking do it. So first things first, TPIs, no major changes. Of course, there is a slight marginal change in the medium-term TPI, but I wouldn't consider that anything remotely useful or interesting, and that really hasn't changed. So shout out to the student that gave me the new updated Grayscale BTC Holdings chart. This one here is a little bit easier to read, and it doesn't have the labels over the screen, which is quite nice. So I might be using that in coherence with the one in CryptoQuant. But I'm going to get into this letter from Capital Wars first. This one called the Liquidity Transmission Process. This is a beautiful, very, very important letter, and I cannot wait to take you through this, because this is an example of how, when you have statistical analysis and you apply it to your investing activities, you can learn very interesting things about the market. And if you fail to speak the language of money, which is math and statistics, then very interesting shit like this will be out of reach for you, and you won't be able to understand it. It's critical stuff. So, I mean, this is a beautiful letter. So let's go through it. By far the most frequent question we are asked concerns the timeline that runs from a measure of global liquidity to the impact on different asset classes. The statistical analysis of financial data is never easy, both because many things often happen simultaneously and because the data is rarely stationary in a statistical sense, with stable mean and variance. On top of that, the arrival of alternative asset classes such as Bitcoin often creates new channels of influence, different feedbacks, and inevitably short sample sizes. However, because the task is difficult, it is no reason to avoid trying to rigorously uncover these influences. We report here the results from a vector order regression model that uses weekly data from 2010 onwards. Important to remember weekly. Note that this period excludes the GFC, which is good, We do have monthly data stretching back to the mid-1960s, but we only began collecting weekly data in the late 2009, hence the data restriction. Vector autoregression models allow us to better understand the dynamic response of interconnected systems, and they can highlight the important pathways and key drivers of exogenous forces within the system. To ensure data stationarity, all variables are transformed into first differences, i.e. weekly changes. This would be effectively him saying you're going to take the first derivative of the data and move it into weekly rate of changes, which is a very valid and a great way of doing data comparison if you have multiple non-stationary data sets that you're trying to compare. So fantastic. The following two charts plot the underlying data. First tracks S&P 500 and global liquidity. As you can see here, this is nothing new to us. We've seen this a million times before. It is defined as the balance sheet capacity of banks, of credit providers worldwide. It includes traditional banks, shadow banks, repo market transactions, and cross-border investment flows. Safe to say, this is not M2 money supply. In many ways, our definition starts where conventional money supply measures end. We're focused more on money that circulates in financial or asset economy. So this is really where the nuance for monetary liquidity becomes like a bit hazy. And what we understand as liquidity and the meme of the money printer go burr, that of course, yes, is a mechanism of liquidity, but liquidity is also due to the multiplier effect of lending and borrowing and debt activities and things like this as well. So that's actual money being created that can be used in asset markets, but a lot of it can be through also fractional reserve banking, for example, is a great example of this. So liquidity isn't just like money being printed. It is often a lot of other things as well that contribute to the ability of people to use money to purchase assets. But of course, that's probably all covered in his book Capital Wars, which we won't go into. The second chart shows global liquidity plotted against the basket of monetary inflation hedges. So now we're getting into the discussion that's relevant to us. The latter consists of a market size weighted aggregate of gold and cryptocurrencies. We have argued before that rising global liquidity represents ongoing monetary inflation that should ultimately be reflected in inflation hedges, such as gold. Cryptocurrencies such as Bitcoin may act as exponential gold for new generations of investors. The data is reported in an index. This swing tends to be more dramatic and largely come from moves in Bitcoin. So if you look at this chart, what you can see is that this, I believe the monetary hedges index is an 80-20 index of gold and Bitcoin. And you can see here we have the phases during over here and over here and over here. You can clearly see the influence of Bitcoin, especially in this phase over here. Classical double top, and the majority of this index seems to be dominated by cryptocurrency market behavior from about 2018 onwards. You can see here basically the entire behavior of this index is Bitcoin, despite gold being the majority of the weight in the index. So you can really see what the power of this asset class is, but also you can judge with your eyes. You can see the correlation between the indices. So we're not going to go into that. We already know that gold is an inflation hedge, monetary inflation hedge. Remember, important key point. CPI is not monetary inflation. They're two different things. So if I have anybody come to me and say to me, hey, Adam, inflation is going up. Why the fuck isn't Bitcoin rising? I'm going to get extremely angry. I'm going to try and calm myself down now so I can finish this off. So statistical testing is heavily jargonized and inevitably can be wonkish. We have tried to simplify conclusions without compromising on rigor. The main test involves causality. The most accepted method is the Granger causality test. This is a two-way test that statistically evidences whether A causes B or B causes A. It is possible that A and B can be highly correlated, but still reveal no causal effects. Preliminary bivariate Granger causality tests show that weekly changes in global liquidity DGL appear to cause changes in S&P 500 3 weeks ahead. So, first insight, very interesting. The table is written in stat speak. The null or benchmark hypothesis of no causation from the S&P 500 to global liquidity has an 8.3% probability of being correct. In contrast, no causation from global liquidity to the S&P 500 has a near zero probability, or 0.3. So at the 5% level of significance, which is common within stats, we must reject the claim that global liquidity has no effect on Wall Street. But we cannot reject the alternative that the S&P 500 index has no effect on global liquidity. In plainer terms, and avoiding jargon and the inevitable double negatives, it seems safe to conclude that Wall Street is influenced by prior moves in liquidity. So you can see that this is reflected in the probability stats here, and you can see where the lag is reflected here. But of course, we are not interested in the S&P 500. We are interested in Bitcoin. An equivalent analysis is shown below for Bitcoin. This shows a more compelling Granger causality relationship between global liquidity and Bitcoin. Again, we must reject the claim that Bitcoin affects global liquidity. But we cannot dismiss the alternative proposition that global liquidity drives Bitcoin. Now, at this point, you're all probably, your heads are spinning, and I totally understand why, especially if you're not familiar with statistics. In statistics, we don't try and prove things. We use an application of the scientific method in stats, which is to try and disprove things first. So you really try and disprove something before, because you can never truly prove something. That is the mentality shift that a lot of you will naturally have an issue with, because the human mind and all the biases that are within your brain, again, if you're paying very close attention to me and everything that I do here, you'll notice that this is a fucking application of Thinking Fast and Slow by Daniel Kahneman, and how you will have a certainty bias within your brain, and you'll be like, oh, well, why aren't we trying to prove things? No, you try and disprove things. You eliminate rather than prove, because you can never truly prove anything, but you can disprove things. So that's the reason why stats always works from their hypothesis testing of trying to disprove things first. So we cannot claim that Bitcoin isn't affected by global liquidity, which means there is potentially an effect in there. There is potentially a relationship, but we're not going to say, we can never truly say at any degree of statistical significance that global liquidity causes Bitcoin, but we can say that we cannot dismiss the alternative that global liquidity doesn't cause Bitcoin. So anyway, the point here is that if you look at this, you can see the level of probability is very high, which is great, because it means that there is the reverse of that, the inverse is that there is a high probability that Bitcoin is caused by global liquidity. But also look at the lag, which is covered a little bit later in this letter. The lag is interesting because you can see that it's different to the S&P 500. So the question is, where did they get this lag from? And also, how do they know for sure? Like, what is the significance of 3 and 5? He doesn't super go into it, but the fact that 5 is here, this actually tells us a lot about how global liquidity affects cryptocurrencies and what we can use that for moving forwards. Now, in case it isn't clear to you, when you see me getting excited about stuff like this, like, get excited, because I would like to assume that you're all smart enough to know that you shouldn't be getting excited about the things that you should be excited about when I'm talking about cryptocurrencies. You should be looking at my reaction of what I find interesting and exciting, and then looking at that, because that's the whole point of you being here, right? I hope to God that people understand that difference, that you can't trust your own judgment, but I don't want to say you can't trust your own judgment. That sounds mean, but you should be trusting my judgment more than yours if your intention is to learn from my experience. These simple bivariate relationships are less robust than a more comprehensive systematic approach, but for this we need to use the vector autoregression model. This unfortunately can be very wonkish, and so they're summarizing it, all of their analysis in this flow diagram here, which we will cover in just a second. We'll blast through this very quickly. I don't believe that's useful for us. But anyway, we have this causality kind of flow diagram. I wouldn't call it a matrix, but basically everything starts at global liquidity, and when we have changes in global liquidity, how does that affect different things, right? Moving outwards in this direction, because I don't know what the resolution of this video is going to look like from you guys, but the direction is outwards from global liquidity. It also moves out to central bank liquidity and the interplay between those two, but that's not really a major concern of ours, except to say that global central bank liquidity behaviors can have a massive effect on global liquidity, extending very far out into the future, as you can see here by the 52-week mark. And also not entirely certain what the fuck they mean by S&P 500 causes Bitcoin and S&P 500 causes gold. I'm not really that's a relationship that is mind-blowing, and maybe we will look into that a little bit deeper later on. But for the moment, we're going to look at global liquidity and its causal relationship moving outwards to these different asset classes. So as you can see, the strongest relationship that they have been able to determine is the 5-week relationship from global liquidity to Bitcoin. The shaded arrow represents a warning that there is a low sample size, only going back to, well, the beginning of time for Bitcoin, but he considers that to be a low sample size for a financial asset. We have a high sample size for the S&P 500 and for gold. Interestingly enough, the relationship between global liquidity and gold is a massive 36-week lag. Now, this opens up a potential interesting discussion about the interplay between Bitcoin and gold and how you may be able to use a rotation between cryptocurrencies and other global liquidity inflation hedges such as gold as kind of like a balancing or like a rotational kind of system. Like after Bitcoin is pumped, maybe you'll move into gold. And then after gold has pumped, then you move into something else and you wait for the cycle for Bitcoin to repeat itself. And of course, he's got 5 weeks here for S&P 500, which I thought was 3 weeks in the previous statistical table. So I'm not sure why that is. Maybe that's an error. But anyway, so that's very interesting there. Whoops. Right. For the record, we reproduce the impulse function, response function for global liquidity shocks of the S&P 500 to Bitcoin. Again, it's hard to read too much into these results, but they both seem to show significant effects from around the 1-month investment horizon lasting some 10 weeks afterwards, which is actually representative in these charts here. I believe these charts are in weeks. So what the 1-month mark is out here to the 10-week mark, where the effect is almost back down to 0 again with a margin of error that's very low. But also earlier on, you have the greatest effects, but the margin of error is also much higher. So the dotted line kind of shows you that both for the S&P 500 and for Bitcoin, the response is highest for the S&P 500 around the 3-week mark, and for cryptocurrencies around the 3 to 4 week mark. So around the 3, 4, 5 week mark is when Bitcoin discounts, and this is a financial term saying it reflects the changes in global liquidity at the strongest level. Now, of course, there's a lot of variability in the short term. There's even a negative reaction in in the short term. This is fascinating to me. So everything up to about 5 weeks, or maybe even slightly less than that. So the month after you have an increase in global liquidity, you would expect to see positive effects within cryptocurrencies. And the fact that you have the strong relationship between global liquidity and the S&P 500 and Bitcoin, they almost have very similar characteristics. It's almost like cryptocurrencies are acting more like stocks than they are gold. Using monthly data, we find longer lead times of nearly 6 to 9 months. So again, we caution that these specific results may be very sample dependent. It's also true that global liquidity shocks cluster and are unlikely to be single 1-week events, which is how they have been modeled here. In other words, a sea change in monetary policy could last several quarters at least, and hence the impact of the change to global liquidity would be ongoing and long lasting. Our main exercise here is to establish the causality of global liquidity. We have used Granger causality tests both in bivariate and vector regression format. These seem conclusive. Global liquidity matters. So that is, I think, a fantastic piece. Absolutely fantastic. And this is probably the most useful insight out of this thing. So when we're looking at global liquidity changes and we are pulling up these different charts, and I'm telling you things like, okay, we've had a new release from Cross-Border Capital over the last couple of weeks where it said that global liquidity is rising and the prices are falling. And you may be saying to me, oh, well, Adam, why, if global liquidity is going up, why is price falling? Well, the market is not an instantaneous discounting mechanism for global liquidity yet. There's probably still a lot of nuance to how it's going, and maybe different types of global liquidity have different reaction functions as well, like more direct, visible forms of global monetary liquidity, such as quantitative easing or yield curve control, or any like direct monetary stimulus coming from a central bank may have an immediate response in the cryptocurrency market, but more concealed, more gray area kind of liquidity stuff like the shadow monetary base or like capital values from like volatility, like the MOVE index. These things may cause a more lagged effect in combination with real monetary printing. So the takeaway here is that when you see price dipping like this and global liquidity is rising, what they're saying to you is that at the state, let's actually do the measurements. So I can't do it in my head. So it is from immediately, so 4 to say 3 to fucking 5 weeks ahead, you will see the most reaction. So total on the weekly chart, looking quite fucking freaky there. You may see high levels of volatility in the coming weeks. Wait, let me go back to the daily. Yeah, beautiful. All right. Okay, so with this zone over here, this zone here is the zone. I mean, it doesn't need to start there or stop there necessarily, but this zone here is the zone where you would expect to see the highest reaction from Bitcoin or cryptocurrencies to an increase in global central bank money liquidity. And isn't that interesting that a rapid increase in global liquidity now, which is the most recent like couple of updates that we've had, places us here in late February after the Lunar New Year, starting from the fucking 15th of Feb, which is basically when you would expect a rapid increase in the news of China printing. So you could have sideways through here, and then it runs up through this 3 to 5 week period, maybe even all the way out to 10 weeks or longer, depending on how how liquidity changes. I mean, if you remember from yesterday, the liquidity chart, there is still distance to go from the 3-month rate of change upwards. It can still improve. Admittedly, it's at quite a high level, but it can still improve marginally, and that I don't think that would be a problem. But there's scope. Like, even though it's been rising rapidly, and from the last update, you may not expect it to increase for a little while yet. So there is still a lag, and one of the most interesting things would be to see how this lag changes over time. You may find that the response function of global liquidity to Bitcoin, this curve, instead of being like this, in say another 6 months, the curve may be more like this. And then in another 6 months, the curve is more like this. I don't know. The fact that the S&P 500 kind of has the same or like more blunted effects, because you can see that within the S&P 500, right? Its peak effectiveness is at 3 weeks, whereas the peak effectiveness with cryptocurrencies is 4 weeks. This makes sense to me that you would have a dramatically shorter impulse than cryptocurrencies, because the S&P 500 is a more mature market. It's more liquid. It has a higher level of competition. It's watched by more people. The cryptocurrency market is getting there, and I would assume that this impulse curve used to be all the way out here, but now it's all the way back here. And it's likely that it will continue to creep backwards. I mean, which is probably represented by this line here, and the reason why these two are so high within this zone. We're in the 3 to 4 week zone with BTC, and we're very clearly within the 3-week zone with the S&P 500, with a dramatic decrease after that. So you'll probably see the the lag time shorten up, but this is actually encouraging. I consider this encouraging because if the S&P 500 has a lag still, despite everybody in traditional finance pretty much knowing that this is a major effect, then maybe cryptocurrency will always have a have some alpha there with global liquidity. Maybe there will always be some alpha that we can extract. I don't know. It's just an assumption, but I found this extremely fascinating and useful, and I think you should as well. So without further ado, let's just get into the regular programming. So we got a letter here from 42 Macro. Cool. So there's been a lot of people on social media saying stuff like, oh, well, the fucking labor market is crashing and there's a lot of people losing jobs. So isn't this a problem for the economy? And maybe we're going to have a recession after all. Looking at headlines is not going to do the job for you. And to be fair, I'm not going to do the data analysis myself. So I'm quite happy to rely back on Darius Dale to see what he says. And he says, basically, I'm going to summarize it. The labor market is cooling, not crashing, which is not indicative of a major recession. But we'll go through the summary and then we'll move into the data. So net financing estimates for Q1 and Q2. Surprise to the downside. Boring. Yeah, that's actually the only major takeaway from there. From medium-term perspective, our sanguine views of US fiscal policy and its impact on liquidity continue to be proven right by the data. With abundant liquidity and no recession in sight, bears are fighting an uphill battle to wrestle control of asset markets via risk-on, risk-off phase transitions. Additionally, a cooling but not crashing labor market is supportive of the current Goldilocks market regime, which is great. That's good news. So basically, what I can tell here is that he's saying current data is supportive of a risk-seeking market environment. And now there has been some negative signals here with the stock market, but Bitcoin is still a max long position on their discretionary investment ideas. He's saying that there is a warning for stocks, which is fine. It doesn't really concern us too much if liquidity is high. Now look at the VAMs. This is something that I thought was interesting when I was scoping through it today. Look at the boundary line of the VAMs here. You could have Bitcoin and Ethereum kind of shoot down just a little bit to the bottom of that range and then come back up again. Imagine all the people that would be scared by that. And they would be like, okay, this is the next leg down. We have like a lower high and we're heading to zero. That would be fantastic. I've also heard, and this is completely not related and just something that came into my mind, apparently FTX is actually going to distribute all of their holdings to the people that were on that platform, like in kind or something. And then they're not actually going to dump all of their stuff on the market. Just super cool. Interesting change here. Global liquidity increasingly correlated to Bitcoin. Isn't that interesting? Would love to keep an eye on that one. That gray bar should always be in the positive, in my personal opinion. Yeah, no changes there. As you can see, double positives from the liquidity models, which is fantastic. Yeah. The event of a treasury buyback scheme in May is positive risk factor as well. I don't know what that means, but if he says that it's good, that's good. Yeah, I'm not reading all that. And from memory, the rest of this was good news, I believe. Yes. Yeah. Okay. All right. Full cycle valuation, no change. Full cycle valuation, no change. Let's have a look at our metrics, the ones that we prefer. No major change there. The profit and loss margin is still under its moving average, so I'm going to keep an eye on that. Not really expecting a mad phase transition until to risk on again until that crosses over. Not that it's just the one metric that I'm watching. It's just something to be considerate of, because when I went through, what the fuck does it mean it doesn't support full screen? Fuck you. Refresh the page. Doesn't support full screen. Suck my dick. Right. As I mentioned in the special metrics announcement video, when you have the profit and loss margin moving above and below its moving average, sometimes, not all the time, sometimes it indicates a change of momentum from one phase of the market to another. It's not super accurate, but it's worthwhile keeping an eye on. Just one of a million different things that you can keep your eye on. Now, this was pointed out to me by one of the students. We have literally had a volatility warning trigger on our fucking dashboard here. So what does that mean? Is it bullish? Is it bearish? What state of the market are we in, and what direction are we going? If we had a clustering of those, I may get a little bit concerned. But yeah, generally my bias is bullish, obviously because of liquidity. I think that you may see an increase in short-term volatility, something like what we're seeing now, which is like this, or like maybe like, whoop, like that zone there, instead of creeping along sideways like this, could be like whipping people wildly as we enter another leg up in the market. But I don't know, it's just worthwhile maybe thinking about widening your stops if you're a day trader. Inter-exchange flow pulse, first signs of life. Creeping upwards very slowly. Good to see. I've had a couple of people come to me and ask me, hey Adam, doesn't this metric, like perhaps it's no longer relevant because of ETF exchange flows, like ETF flows relative to exchange flows? And oh fuck the screen. So the simple answer is I don't know. Ultimately, I don't know whether or not whether it's going to be accurate anymore. I would imagine that the people who are buying the ETF are not the same people who are using sex exchanges, and that it's a different cohort of people completely. Also, if this metric already worked with the black, gray, and OTC markets being, moving around cryptocurrencies in the background, and this thing was still working, then I don't see a reason why it can't work with ETF flows. ETF flows kind of like just a different form of flows that happen outside of exchanges. So yeah, I'm not super concerned by that. You know what I was thinking when I was looking at this binary CDD is that these warnings where you've got the red triggering, like back here, specifically back there and back there, they're almost like rotate, because they trigger early. They're almost like warnings to rotate like into Ethereum if you were a Bitcoin holder. I don't know, it's just a thought that entered my mind. The other metrics, good to see that accumulation is still happening with the ETFs. Nothing major there. Going back to the Grayscale holdings, you can see they're still declining off a little bit. As to be expected, they haven't stopped distributing yet. New money. Interesting update. New money has pumped a little bit. Right. New money has pumped a little tiny bit, but it's not really significant. Anything above or below 10 is really the level that I would consider significant enough to warrant our attention, and we are still a very long way away from that, so not going to pay attention to that. MVRV still chilling above its midline, which as far as the LTPI is concerned is a positive trend. Same with the SOPR for the medium-term trend. A little bit of an increase in supply and profit. And nothing major there to talk about. So I'll close that down, have a quick blast through the Capriol website. On-chain indices still bearish for both of those, which is fine. Yeah, still consolidating like I suspected. Macro is not that interesting. What about altcoin breadth? Breadth, the 50-day breadth is still declining, so is the 200. Might be time to accumulate your altcoin bags. It's not a signal. Fine. Yes, good. Nothing interesting there. No updates there. Starting to get into shorter term now. Cool. Oh, which reminds me, I need to update the fully docked signals. I've made some changes to my portfolio. I haven't told anybody. Right, so it is what it is. BTC going up, sentiment going up on negative price is bad because that generally means that people are going to early long, which leads to more downside. Should have it there. Yeah, generally, up sentiment on down price means people are early longing, which means more liquidations. So would not surprise me in the slightest to see that return back down to that realized price, short-term realized price. Nothing there. What did I say? Here you go. It's in stark black and white almost. Same with Ethereum. Solana's looking a little bit dangerous there. Could potentially see 89. At this point, if you see 80, if you see the 80s, you should probably load up your Solana bags. Honestly, the more I think about it, the more I think Solana could possibly outperform earlier in the cycle, kind of like Bitcoin. Still, I think at the end of the fucking bull run, Base Chain and Ethereum are still going to outperform. But at the moment, it seems like Bitcoin and Solana are doing most of the heavy lifting. And like I've mentioned previously, the Sol ETH ratio is basically just Sol. Although it wouldn't surprise me to see Solana consolidate for a while, though. You know, it may underperform for a period of time before returning to outperformance. If I just pull up something retarded like my Insilico dashboard, for example, if you go to like an ultra high time frame thing, like a 2 week, like a 2 or a 3 week, it's like, oh shit, Solana's entering a downtrend at this point. But of course, during a parabolic uptrend, normally the Insilico indicator doesn't do a great job of capturing that. Generally, it whips a little bit. And sometimes you have late signals on that one. Look at that 1 month. Oh dear. Only 2 top signals in history, and we're getting 1 there and 1 there. Anyway, this isn't a fucking technical analysis stream, so I'll return back to the analysis. Yeah, it looks down biased. Again, everything's bearish. Fuck. Even that's rare to see Solana that's that fucking bearish. That sucks. Wonder what. Ah, fuck! I closed it already. Solana. Nothing major. Okay. That needs to be over there. Yes, yes. Nothing new. Already checked that. And oh dear. Macallian summation index on its way down. It's not good. All right. So overall, my expectation is that currently it seems like we're in the midst of a bit of a downtrend. Well, a short-term downtrend, which is not good. But yeah, I wouldn't be surprised to see that return back to its realized price. I mentioned to you previously that I thought that range, that triangle in there was going to be the thing that gets filled with some consolidation. And it seems like it went a little bit higher, so we may have a bit more waviness within this consolidation. Don't get chopped up. Don't fucking overtrade. Don't over swap around positions. It's one of those periods that if you're happy with your bags, especially if you're an SDCA portfolio holder, the magic really is not fucking around too much. Understand what you want and have a portfolio of things that you're happy to hold for a long period of time. The SDCA portfolio is not a portfolio where you actively manage every single holding the whole time. That's what the RSPS is for. Remember, every decision you make opens yourself up to a failure. Now, I know that sounds negative, and I don't like to be pessimistic. However, on balance, the majority of your choices as an uninformed individual are going to be the wrong choices. There, of course, are optimal choices, and at a higher level, such as which token's going to have the most likely upside, which is like going from market cap downwards, and which ones are going to outperform what part of the cycle. I know a lot of you are trying to over optimize for that because you're very impatient. If you're a very impatient person and you don't want to have the highest probabilities in your favor and you would rather gamble, then I'm not the guy for you, right? I don't do gamblers. I don't do gambling. I do a little bit of gambling, but with like a tiny little baby part of my portfolio. Everybody's got a little bit of gambling in them. And, sometimes managing that is part of the game. But yeah, I don't do ifs or buts or maybes. I know for sure something is going to go up, so I'm going to apply a whole bunch of money to it. I'm going to wait for a while. And if I have some relative outperformance between different things at different times, then I will do some rebalancing, maybe. But I don't like to fuck with my portfolio very much. I'm holding things that I like to hold for the long run. So if you're wanting to be super actively managed, or you want to gamble or reduce your probabilities, then you'll need to fuck off somewhere else, because that's not who I am and that's not how I made my money. So, is there really anything else for me to talk about? What's this metric doing? It's still kind of creeping up. The liquidity proxy, it's still kind of creeping up. What's going on here? Liquidity creeping down. Hex looks like it's about to go for another leg up, bruv. If it doesn't nuke before that. Shame to see Doge not outperforming, Dogcoin not outperforming during dog season. It's a bit unfortunate. When is next dog season? Thanks, Van Helsing. Next dog season is from the middle of March to June. I see. So that's all the way out here. So there's still a hope. You're telling me there's still a hope. This dog season didn't play out like we thought. The January dog season, it was down only. It's very unfortunate. Another useful lesson on how seasonality effects are complementary effects, and they're not drivers in their own right. So if you had reason to believe that dog coins were going to go up, they would go up in January. Anyway, I'm going to just ramble if I spend any more time here, so I'm going to cut it here. Thank you very much for your time, guys, and hopefully you enjoyed this investing analysis. Hopefully you learned a bit from it, and yeah, make sure you get those lessons done past the masterclass. Share love forwards to your fellow beginner students, guide them, tell them where to find all the information, and of course, show up every day for your lessons and for the investing analysis. Peace out. Talk to you guys soon.